Good day, ladies and gentlemen. Welcome to the show. Listen, I'm glad to have you guys here. Today is it's a Thursday, December 19th, 2019. And, I'm going to tell you, it's no secret how I stay on top of these markets. I religiously, 7 days a week, do at least 4 hours of research into these markets. And I have for years. For many years now on this channel. This is how I stay on top of these markets. It takes diligent research. I have a high-speed internet connection here. I can go anywhere on the internet and learn anything that's going on, and there's a certain method I use to my research. Anyway, going back way into 2018, I was saying on my channel here, hey, you know what? This quantitative tightening is not going to work. They're going to have to go back to quantitative easing. I was saying that quantitative easing to infinity is coming. Quantitative easing, right? And this was a long time ago I was saying this. And they were going to have to drop interest rates down to 0 or below. I was saying that they were going to have to try to turn this ship around. I used the illustration of a ship, and back then when I was saying this, when I first started saying this, we had a different head of the Fed in. We had Janet Yellen. This was back in Janet Yellen, I was saying this. Well, it's come to fruition now. It's happened. Everything I said has happened. Within the bond market now, they got problems. Let's get the charts open right here and take a look at what's going on. House impeaches Trump was one of the big articles here. Okay, and the second article is China talking with the United States on signing a Phase 1 trade deal. So we got these things going on right now with this talk about a new trade deal. The trade deal is the biggest thing. It's standing there, and it's probably going to get signed in January. That's what I'm thinking now, that they're going to sign this new trade deal in January. I don't think it's really much of a deal. It's more or less just to take the heat off of everything. That's what I think, my personal opinion. So, we're moving toward a crisis within the financial system. Now, I was listening to a show last night by Jim Willey, and he created a very interesting theory. Now, forgive me if I don't get this quite right, because I just listened to the program once. Maybe I'll go back to listening to his theory again. But his theory, basically, the way I understand it, goes like this: that they've already had some sort of a meltdown within the core of the financial system, where the banks trade back and forth between themselves, different financial products, that they've had some sort of a meltdown, and they don't really know who owns what, or who owns what, but they're still holding these assets. But the ownership is unclear, so this is why they've stopped lending, interbank lending, and lending to the hedge funds and stuff in the repo market and stuff, is because they don't know who owns it. And that basically his theory, I guess, goes like this: that the Fed's just basically buying it all. I can't discount what he's saying. I can't discount it. I don't know if it's true or not, but it would answer a few fundamental questions, of what's going on within the repo market. There's a lot of theories out there right now about what's going on in the repo market. We all know something big's going on. I mean, $500 billion? We know something big's going on. We just don't know exactly what. So they're not being transparent about what's going on. So that's why all these theories are popping up about what's going on. But I'll tell you what I think. I think that this is going to force their hand to go back to real quantitative easing, and not in a small way, in a big way, in the very, very near future. And when they go back to quantitative easing, real quantitative easing, not this buying T-bills, but 60 billion worth of T-bills a month, but I think they're going to add to it. the real quantitative easing, and they're going to uh, use that power to help them control the yield curve and help them control this situation that's going on right now. And I think that's coming early next year. And so once they do that, all credibility is lost for the Fed at that point in time. I think that's when we're going to start to see a turn in everything. People are going to start to realize, hey, you know what? They can't stop this monetary madness. It's just going to get worse and worse until it destroys the fiat currencies. It's as simple as that. Let's take a look at the silver price today and see what's going on with the silver price. We see it had some dips. It had a couple dips, and now it's moved back into its range. It's at 16.95 right now. You can see this tight little narrow trading range that it's staying in, around 16.95 to 17.10, or no, 17.05, maybe 17.10. It's the center of that range is right at $17. Okay, a very tight narrow trading range. Let's take a look at gold. Gold's at 14.75, and it's got that same tight little narrow trading band right now. I'd say the center of the gold's trading range right now is like 14.76, is the center of that range. Now let's take a look at what's going on in cryptocurrencies today. And we've seen cryptocurrencies has had a hard little rough go of it. But it's 188 billion, 188.8 billion today with a Bitcoin dominance of 68.3%. And we see the coins starting to rise a little bit again, Litecoin's getting up near $40. Bitcoin is at 71.21 and starting to look a little bit more positive again. We might have just tested a bottom, We'll have to wait and see, but we might have just put in a bottom. Let's take a look at the Dow Jones today. The market opened 7 minutes ago, and we'll refresh the page. Up 52 points on the day so far, 28,290 right now. I think that's an all-time high. Anyway, what does it really matter? I mean, in the end, this market is detaching from reality now. And all this central bank money that they're printing now and into the future that could drive a hyperinflation. How high can a market go in a hyperinflation? Just keep going up forever. But it becomes more and more worthless in the end if that's the direction that they're going to take. I think before that time comes, before they really get there, I don't think they're quite there yet to what's called the acceleration phase of the hyperinflation, which is the lead-in phase. It's not the hyperinflation, but it's like 1970s style inflation. I mean, a lot of people weren't alive in the 1970s, but take my word for it, I was alive, and I saw the inflation of the 1970s, and it's not pretty. And that inflation's coming back again. That's what's called the lead-in phase to the hyperinflation. And it can last a few months, or it can last maybe even a couple years, that lead-in phase, and it does somewhat stimulate the economy. Because they're pumping so much money in, the velocity of money starts to speed up during that lead-in phase, which is the acceleration phase. Acceleration is a good word for it, because the velocity of money is starting to speed up. Money is starting to change hands faster and faster. People don't want to keep it anymore, basically. And that's the lead-in phase to your hyperinflation. Let's take a look now at crude oil. 61.02 for crude oil, and we see it creeping up day after day, creeping up. It was in the 50s, now it's in the 60s. Where's it going? It's on its way up. Let's take a look now at U.S. Treasuries today and see what they're doing. What we're seeing is a really mixed bag here in Treasuries, but we're not seeing any real big movement. Almost 2 basis points in the 30-year, 1.7 basis points in the 30-year, 2.36. The U.S. 10 years at 1.93, up 1.2 basis points. So if we're looking at the lower end of the yield curve is starting to move down a little bit, but very insignificantly, and the 6-month is unchanged. Now let's take a look at the U.S. dollar index. And what we're seeing a little bit of bouncing around with the dollar index. It's at 97.39 right now. We had a little pop in the price of the dollar index, but now it looks like it's settling back down again. Okay, guys. Thank you for listening to this show. Like and subscribe. Give me a thumbs up. You guys, Merry Christmas, everybody. Bye-bye.